A lot of traders think that the key to making more money is to trade more. More charts, more setups, more entries, more action. But that mindset is exactly what destroys most traders. Just because the forex market is open 24 hours a day, 5 days a week, does not necessarily mean that you have to trade every single day. And just because the market is moving does not mean you have to be part of it. The truth is, a huge part of becoming a profitable trader is knowing when not to trade. So it's like knowing when not to trade is as important as knowing when to trade. Because as a trader, you only have a finite amount of capital. And if you keep chasing low probability setups, eventually you won't have any money left for the high quality ones that actually matter, that actually make you money. And the thing about these high quality setups is that they don't come around often. But when they do, you need to be ready. You need to be ready to deploy your capital. So in this lesson, I want to show you the market conditions in which you should not trade. So you can preserve your capital, protect your trading psychology, and stop donating money to conditions that were just never worth trading in the first place. So with that being said, let's dive into the lesson. Now, the forex market is open 24 hours a day, 5 days a week, right? Every day is a trading day, but that does not mean that you should trade every day. You should only trade when there is a high probability setup that aligns with your plan. Remember, if you run out of your capital, you can't trade, right? Because if you are pretty much going all in on these low probability setups, you are just setting yourself up for failure in the long term. And just because the market is moving does not mean you have to trade it, right? It's imperative that you guys understand when not to trade, because knowing when not to trade is as important as knowing when to trade. And when to trade is very simple. It's just when there's a high probability setup that aligns with your plan, your mechanical trading plan, take that trade. If there isn't, don't trade. As simple as that, right? But at the same time, there is some days or some months, some scenarios where you shouldn't be taking a trade at all. Okay, and before I talk more about that, I just want to say this, right? 99% of the volatility you see every single day is just a trap waiting for the unsuspecting trader. If you're not careful whatsoever, if you're impatient, if you're trying to force trades when there is no opportunity just because you want to make money, you are going to make a mistake and you are going to lose. Even if you don't make a mistake, the market will induce you to making a mistake, right? And you will lose money. And this is exactly why so many of traders actually lose money in the markets, because they are impatient. Now, quality setups don't come around often, but when they do, you need to be ready. And if you're chasing volatility every day, you're chasing all these low probability setups, you're forcing trades, you are revenge trading, all these type of stupid mistakes, you will not be ready when the quality setups come. Because when the quality setups come, guess what? You either have no money to actually take it, or you don't have emotional capital, right? That means you're not emotionally ready to take that trade because maybe you've been losing the past few trades and your confidence is down after, going through this huge losing streak. Therefore, it's extremely important to know when not to trade so you can preserve your capital for the high probability setups, the ones that will actually work. Okay, and quite simply put, there is two market conditions that you should not trade. Volatile market conditions, or the markets are illiquid. Alright, so let me just explain what this means. Now, based on my 5 years of experience, you should not trade when it meets any of these criteria. Okay, so I'm going to explain one by one. Alright, let me just pull up the drawing tool if I actually need to draw something. So the first scenario is when price is in the middle of nowhere. Now, what do I mean when I say price is in the middle of nowhere? Basically, if you actually follow our mechanical trading plan, right, you identify your market structure, you mark up your point of interest, you should be just waiting for price to get to the point of interest. So for example, right now price is, you just broke structure to the upside. And then right now you are waiting for price to actually come down to this demand zone so you can look for an entry. This means that when price is pulling back, you're not doing anything, right? You're just waiting for price to patiently get down to the point of interest, then you take that trade. Okay, but obviously later on you will learn about the different market phases and you will know that you can trade this counter trend as well, and we actually teach you how to do that. Okay, but for now, just know that when price is not at a point of interest, that means price is in the middle of nowhere. And since price is in the middle of nowhere, you shouldn't be taking a trade, right? Because it messes up your risk to reward. If you try to enter for a trade when price is in the middle of nowhere, where should you place your stop loss? And where should you place your take profit? You realize that you will most likely get a very, very bad risk to reward, like a 1:1 risk to reward, or even worse than that, right? So when price is in the middle of nowhere, do not trade, okay? Do not trade whatsoever. Just, after you do your analysis, set your alerts at the point of interest that you want to enter on, and just patiently wait for price to tap into that point of interest, and then go and look for your entry model. So price in the middle of nowhere, do nothing. Price tap into the point of interest, that is where you can start to look for your trading opportunity. All right, and I know this might sound super simple. You might be thinking, Brad, I already know this. You said this 1,000 times. But trust me when I say that this is where so many traders mess up, right? Even though you know what to do, you just don't do it, right? You ignore my advice and you try to enter for a sell right here where price is already entering into our discount zone, entering into this demand zone right here, and try to enter for a sell here when it's way too late to trade your counter trend, right? So there is different nuances to how to trade the market properly, and like I said, we will go deeper into that in the multi-time frame market phases course module, the lesson, right? For now, just understand that, okay, if price is in the middle of nowhere, don't trade. Even if you are trading the counter trend just like this, right? So let's say you're trading the counter trend, you're trying to sell during this pullback, right? In this case, if you want to enter for a sell, you should be waiting for price to get to this supply zone, right? And then you actually look for your entering for the sell and actually trade the counter trend. So if price is like right here, it's in the middle of nowhere as well, right? Because price has not actually mitigate any point of interest, right? You should only trade after price mitigate a point of interest, show your entry model, then you take that trade. If price mitigate a point of interest and you don't see your entry model, same thing. You do not take the trade whatsoever. All right. So yeah, that's that. That's the first point. When price is in the middle of nowhere, that's a no-go. All right. Next, when you're experiencing slow and choppy price action and there is no clear buyers. Now, what I mean right here is where it's similar to what I said right here, where price is in the middle of nowhere. But in this case, it's slow and choppy price action. Okay, so maybe just let me go onto the charts and show you some examples of slow and choppy price action. This right here will be a good example of slow and choppy price action, right? You can pretty much see price is just oscillating, right? Going sideways. There is no clear bias whatsoever, okay? Because if you look at the overall trend, right, we are still bearish. And if you are still bearish, we are waiting for price to, mitigate some form of supply that we have right here, or even like right here, right? We're just waiting for price to mitigate that supply. So if price is like slow and choppy, just going sideways like this, there is no clear bias. We can't really tell whether price is going up right now or whether price is going down. It's just chopping around within this range. This is the market condition that I don't personally trade, right? And yes, we teach you how to trade consolidation, and you can do that, right? But for me personally, I just try to stay out of the market when price is consolidating just like this, and it's slow, and the price action is very choppy, it's very unpredictable, right? There is no clear buyers, right? Because price is sweeping the liquidity from this high, this low, and then price is sweeping the liquidity from this high as well. And right now we are just back to exactly where we start, right? We started off right here, and then right now we are back to where we start. Price in the middle of nowhere, no clear buyers whatsoever. We are neither bullish or bearish. We are just going in circles, right? So in this case, it's honestly a waste of time to trade this condition. Just wait for price to actually break out of this consolidation, right? And have more smooth price action like what we see right here, very smooth price action. Then you can go and look for your trade opportunity, right? Slow and choppy price action, just don't bother, honestly. Okay, so next is Mondays and Fridays, right? I personally do not like to trade Mondays and Fridays as well. Okay, so you must think about it in this way. So when the market opens on a Monday, this is where the retail traders, or rather majority of traders, just come back onto the market after a 48-hour break, right? Because the markets are closed on Saturday and Sunday, right? So the markets are closed on Saturday and Sunday. As a result, Monday, when the markets open, this is where traders, they come back after this 48 hours break, and they are slowly settling in to their trading desk. So as a result, there's going to be lower trading volume, okay? There's going to be lower trading volume. However, there are some exceptions, right? If I see like a top-notch A+ extreme high probability setup on a Monday, then yes, of course I'm gonna take it, because my trading plan states that if a setup meets my criteria, I will take the trade regardless of the day, right? But yeah, if it's just like a mediocre setup, it's like an to me, yeah, Monday I just try not to trade, right? Because this is where there's a lot of traps on Monday, right? And Monday is also the day where the market is like trying to determine which direction price is going to play out, right? Is it going to go up within this week, or is it going to go down in that week, right? So Monday is another scenario where I just don't trade on Monday, okay? And also there's a lot of traps on Monday, right? Especially since, the market just opened, right? Example, when the market open, it could open at like a gap, right? You can open with like a gap up, right? Like, and then market open right here. And then as a result, you might think that, the market is actually bullish right now. But then this gap up is just to sweep the liquidity from this high. And then next thing you know, price just turned incredibly bearish. So there's a lot of traps on Monday. And once again, the market is still trying to figure out where to go for the following week. So yeah, Monday is just not for me, right? And another thing is Friday, right? So other than Monday, I also don't like trading on Friday, okay? Reason being, Friday, there is a lower amount of trading volume, right? There is lower liquidity because the market is ending right now. So Friday, that is where the institutions, they are closing their books, like they are settling, they are getting out of their positions, right? So there's going to be lower liquidity. So the markets are illiquid, right? That's one thing. And there is going to be very less trading opportunities on Friday. And then another thing is, if you try to enter for a trade on Friday, you are likely going to hold a trade past the weekend, past Saturday and Sunday, especially if you're a swing trader. And if you're holding the trade over the weekend, there is going to be a rollover fees that you are going to incur, right? So yeah, that just cause your profit margin to just decrease, right? So as a result, I don't trade on Friday as well, right? Unless I'm already in an existing position, right? So the only exception to this rule right here is that if I'm swing trading, I'm already holding the trade from last week, then yeah, obviously I'm going to continue holding the trade until price hit my take profit, right? So I'm not going to like close the trade just because it's Monday. No, I'm just going to hold the trade over Monday, Friday until the price hit my take profit. So that's if I'm swing trading. But if I'm day trading or even scalping, I just don't like to trade on Mondays and Fridays. All right, so yeah, that is that. And then fourthly, December. Now, December, this is where institutions, they are taking a break, okay? The smart money, they are, going away for Christmas to spend time with their family, going on a vacation for the winter, whatever it is, they are taking a break, right? I mean, they have been working for 12 months, right? So obviously, they deserve a break as well. So when all these professional traders, these smart money, these institutions, they are on a break, guess what? The market is going to be very illiquid, right? It's going to have less trading volume. And since there's less trading volume, it's more illiquid. That means the markets tend to move slower, right? And it pretty much just goes back to this. And pretty much from December onwards, right? Or rather the whole month of December, you'll most likely see slow and choppy price action, okay? If you don't believe me, let me go onto the charts and prove it to you. Okay, so this is December 2 years ago. Right now we are still in November, so I can't show you the price data for this year, December. But this is from December 2022, right? So once again, I just wanted to show you how many pips did price move in December for EURUSD, right? You can see EURUSD start of December all the way to the end of December. It pretty much chopped around for just 250 pips. 250 pips for the entire month. Do you know how less that is, right? And just to put it into perspective, let's look at November, right? November, price moved almost 800 pips. That's 4 times more trading volume than in December, right? Not really trading volume, but 4 times more volatile in November than in December, right? Or even let's just look at October, all right? Let's just look at October. October itself, it moved over at least 500 plus pips, right? And if this doesn't convince you, just look at the price action, right? October, we got price pulls back, goes up, pulls back, right? Normal price action. November, same thing, goes up, pull back, goes up, pull back, normal price action. And then come December, price goes up, make this minor pullback right here, and then just you can see how slow the continuation is, right? It's very, very slow, and it's very choppy. You can see pretty much after mid-December onwards, it's just chop around here. And then coming into Christmas, the market is just not moving anywhere. The liquidity is extremely thin. And then coming New Year, price action go back to normal again, right? So please, for the love of God, just go and spend time with your family. Go and, I don't know, kiss under the mistletoe, or like decorate your Christmas tree, celebrate your Thanksgiving or Boxing Day, whatever you guys celebrate. Just go and chill during December, right? Pretty much from December 1st onwards, just go and take a break, right? If you've been trading for the entire year, you deserve a break as well. Just because you don't trade for 1 month does not mean that you are going to, like, I don't know, lose your trading ability, all right? So don't be stupid. Just December, just take a break and then come back with a fresh mind when the new year actually starts. Next is immediately before and after high impact news, right? When you go through the fundamental analysis course module, you will know why I don't trade during the news. I don't trade immediately before and after the news. I have this rule called the 30-minute rule, or rather the 15-minute rule, right? You basically wait 15 minutes or even 30 minutes after the news come out, then you actually begin trading again, right? So yeah, that's what I personally do, because the news, when the market just going crazy during the news, right? You will learn more inside the fundamental analysis course module, but basically the volatility is extremely high. The spreads are extremely high as well. It's expensive to trade during the news. You're gonna incur a lot of commission. The broker costs, and yeah, it's just not worth it. All right, and there is no edge in trading the news. Remember, we are professional traders here. We are not gamblers. If you are gambling, by all means, you can trade the news, right? Try to predict whether price is going to go up or down, but more often than not, markets are just manipulated, and you are most likely going to lose money in the long term if you trade news, right? So immediately before and after high impact news, we don't touch price at all. And next is when you are not in the right mental states, right? This is something that is so underrated that people don't actually talk about. Now, what I mean when I say the right mental states, remember, trading is 80% mindset and 20% strategy. You need to ensure that you are 100% focused without any distractions when you go onto the charts and scan for your trading opportunity. If you are distracted, you are just going to lose your money, or rather transfer your money to the other trader who is extremely focused and disciplined. So why not just take a break, right? If you are, if you are facing something difficult in your life right now, right? Maybe you have family issues, or you just broke up with your girlfriend, or you are really struggling right now and you're just not in the right mental state, right? Maybe like a loved one is hospitalized right now, so it's difficult for you to trade and focus on the charts because you keep on thinking about something else. When that happens, do not trade, all right? Please, for the love of God, do not trade. Because when you go into the charts, you need to make sure that you perform at your 100%. You need to make sure that you are extremely focused and extremely disciplined. And chances are you will not be able to do that if you are distracted by whatever that's going on in your life right now. So if you're going through a breakup, you're going through a divorce, or you're just not in the right mental state to trade, just go and do something else. Maybe go try therapy, or walk in a park, or go to the gym, or watch Netflix if that helps you, but just don't trade, all right? Because you're just going to lose your money, and you're just going to use the market as a way to vent your anger or your sadness. And you are doing that by losing your money, and that's going to cause you to become even more depressed and even more angry, and that's just going to cause your mental state to go into this downward spiral, and that's what I don't want to see, all right? I want you to not just be rich, but also be mentally well and spiritually well, all right? Next is losing streaks, okay? So I believe I've already mentioned this a few times, right? When you are going through a losing streak, you have lost the past 10 trades in a row, maybe it's time to steer clear the markets, sit on the sidelines for a bit, reevaluate your trading plan, or reevaluate the past 10 trades, review your trading data, see what you have been doing wrong, right? What mistakes you keep on committing. Are you continuously just revenge trading and just causing your losses to get bigger and bigger? Basically, just reset, right? So stop trading. If you've been losing the past 5-10 trades in a row, stop trading. Really go and look at your plan, right? Look at the past few trades, find out what's the mistakes, so you can do more of what works and less of what doesn't work. And then, yeah, you might need to adjust or refine your plan before you get back to the market with a clear and focused mind. Okay, so if you are going through a losing streak, just don't trade, right? Just close your laptop, close your computer even, right? Just don't look at the charts for like at least 1 week or so, right? Really go and get a mental reset before you come onto the charts. Because if you don't do this, what happens is that you're just going to fall into this downward spiral of analysis paralysis. You lose a trade and then you start taking even more trade. You start revenge trading, trying to make back the money that you have lost. And then you lose that trade as well. And then you suddenly just keep on getting very depressed. And yeah, and you just start losing faith and confidence in your trading ability. And now you are doubting yourself, thinking whether trading is that right career path for you. Maybe just quit trading and go back to a 9-to-5 job or whatever. And yeah, this is just going to cause you to end up quitting trading, right? When you are so close to becoming profitable, if you just push forward and just push through this phase, right? So there's that. And then the last condition is the last trading day of the month, right? So it could be the 31st or 30th, right? It depends on like which is the last operating trading day of the month, right? And usually this is a day where institutions, they close their books, right? Since they are closing their books, they are done trading, then yeah, once again, it's the same thing like what I mentioned right here. There's going to be low trading volume, not much trading opportunity in the market since the markets are illiquid, right? So yeah, those are the times that you should not trade. Remember, when I say that, knowing when not to trade is as important as knowing when to trade, all right? And the best time to trade is when a setup meets your criteria. Okay, when you see that trading opportunity that lines up with your trade plan, execute the trade without hesitation, without reservation or fear. And if you lose the trade, eat the loss and move on, because you trust your plan and you know that in the long term, your discipline will pay off and your trade plan will actually play out and you will be consistently profitable. So hopefully after this lesson, you can see that one of the best skills that you can develop as a trader is restraint, is patience. Because like I said, profitable trading is not just about knowing when to enter. It's about knowing when to stay out, when to sit on the bench, when to sit on the sidelines and just observe. The market is open every single day, but that doesn't mean that there's opportunities every single day. A lot of the volatility that you see that's going on in the market, most of the time is just noise. It's just traps. It's just low quality movement that is designed to punish the impatient traders, designed to make the retail traders liquidity. So yeah, please have a mindset shift. Stop thinking that you need to trade all day, because you really don't. You only need to trade when a setup clearly meets your criteria and the conditions that actually support your edge. That is the real key. Protect your capital, protect your mental state, and save your bullets for the moments that actually matter. Because at the end of the day, the best traders are not the ones who trade the most. They are simply the ones who know exactly when it is worth doing nothing. So with that being said, I look forward to seeing you guys in the next lesson. And as always, remember, you're just one trade away.